Well folks, welcome to lesson number 9, trading for profit. Now it's such an amazing thing trading Forex and discovering that you can get into lots of winning trades and still be losing money consistently. In fact, the reality is that if you can have a 80% win ratio. That means you can win 80% of your trades and you can still be going backwards. Sounds bizarre, but I will explain why that is. Conversely, you might only be winning 30% of your trades, so that's 1 out of every 3 trades you win, and you could be consistently profiting from Forex. Now it all comes down to money management and understanding how the market actually moves. So a good example of that is if you watch some of Craig Harris's videos talking about the natural flow of the market. If we look at the 15-minute time frame and we look at any of the swing lows to the swing highs we see here, we will see that typically there's 30 pips, there's the swing low here to that one there, there's 20 pips, there's almost 20. So what we're seeing is that typically the market is moving, around about 20 to 30 pips at the moment. Sometimes it'll do bigger moves like this, and that's 46 pips. But the reality is, if you look at any particular time frame, as Craig says, the market will move in these kind of natural movements of certain amounts. So on the M15 time frame, the typical moves are somewhere between 30 to 60 pips unless news has been associated with that move. So armed with that information, if I'm on this time frame and I'm taking a trade and I know that the typical amounts of swings from the top to the bottom is 30 to 60 pips, if I aim for the cautious side, I'd say, well, it's 30 pips, and we consider that we get into a trade, say, on a trade signal, then that's going to reduce the distance by about this much. Then you've got to think, well, how much am I going to profit from that? So the initial thing is to say, okay, well, what is the potential to profit from this trade? If it's already done this much on this particular move, 15 pips, then there's possibly only 15 pips left. We have to think about that. We've got to think about it exactly like that. There may only be 15 pips left due to the natural movements in this time frame. Now let's take a couple of examples. So if I was, let's say I'm looking at, this is kind of like a range bound market. It's not trending at the moment, but let's say that we've found a classic kind of resistance point here that hasn't been broken through. We're going to consider that on a break of this level here, we're going to trade this situation because it's not breaking higher. Let's say that now it's broken lower than this point. We enter a trade. So let's say we enter the trade on this candle here at this point. All right, what is going to be the possible stop we're going to use? Well, if we're going to use a 30 pip stop there, that's pretty scary. Or if we 24 pip, what have we left ourselves with an opportunity to trade in this particular trade, knowing that the market's moving 30 to 60 pips? Well, possibly there's only 10 more pips left in this movement. And let's have a look. What have we got? Well, we were lucky. There's about 15 pips kind of came out of that. But let's say we traded it. Now what happens with most people is just this. They enter the trade. Let's just move these along a bit. Okay, we enter the trade on this candle. We place our stop. It's set up here at this big amount here of 22 pips. Now if we lose that 22 pips, that's 22 pips against us for the day. Now the trade starts going, we get into 10 pips in profit, and then look, next candle, it starts moving back on us. But it got to how much in profit? 20 pips. Okay, we leave it on the table, so to speak. The trade comes back and ends up coming back on this candle to here, to 3 pips in profit. Some people will be getting really nervous at this point and don't want to get a losing trade, so they'll take it out. So you take the trade out and you've made 3 pips profit. Now, if we look at this here, this was a 20 pip stop loss. If we were stopped out on 20 pips, that means that if we are typically ending up taking 3 pips off our trades and our typical stop loss is 20, there's not much required to know that our stop loss is almost 7 times as large as our normal take profit. So to break even, we need to be winning 6 out of every 7 trades, at least, to just break even. So the trick here is to be able to go and say, well, what is the normal movements in this market, and say, well, look, we entered that trade, we got 20 pips on the table, let's just take it out. Let's just keep that. Then the market, let's say you didn't, and the market starts going against you. Well, at this point, you would have been 4 pips against you. We probably would have been all right. But then we're holding on, and the market gave us another opportunity to get 20 pips, but we're still holding on. And then, hello, it starts pulling back this much, which is, unfortunately, that was in the way. Let's just have a look. Look, there's 12 pips. You know, you may have got out at that point and you've now got a 12 pip loss. So the point I'm trying to make here is that you have to be aware of how much these swings in the market are. So now if we look at the swing from the bottom here, from here up to there was 30 pips. That's what the market does all the time. It's moving down by this amount, move back up by this amount, and it may move down a similar amount or more. So what we've got to get across here is that the market will move down. You've got to realize how much it's going to move typically, and then get out. Don't let your stops run back and take out your stops so that you end up with your win to loss ratio being stuffed up by the risk reward ratio. So in other words, what I'm saying is the reward here could potentially be only 3 pips if you're trading like I just suggested, because you're too scared to let this run a bit and make some profit. You've got to realize that while you're starting out trading, if you've got a 50-50 win to loss ratio, then what you need to make sure is every time you set a stop of 20 pips, you've got to ensure that you're making 20 pips. Okay, so if you made 20 pips on this, right, once you make 20 pips, you've got to consider, am I getting out of this? Okay, even if you move your stop down to here now, if you get stopped out, the profit you're going to make is only 9 pips, but you started with a 20 pip stop loss. So what you're going to end up doing is that if you keep doing that all the time, you're going to end up with only 10 pips normally for your wins and 20 pips normally for your losses, which means that typically you've got to have two times more wins than you have losses to be able to at least break even. So the moral of this thing is, try and set your stops. Your stops on a particular trade need to pretty much be about or less than the natural movement or the cycles of the market. Your take profit should be, you've got to have at least an expectation of this movement where your stop is or more. Otherwise you're going to consistently go backwards. So in this case, price did move down quite significantly, and you may have got quite a good return on that 40 pips, but we have to understand that on the M15 time frame, that's not the norm. It's 30 to 60 pips. Typically we've got in after 10 pips after the movement. In this case that was 20 pips, which is probably not the best trade. This probably would have been a better trade, because we could have entered here and our stop would have only been about 18 pips, and gives us more opportunity to profit from it. So the risk to the reward is how much you're going to risk in terms of the size of the stop compared to how much you typically take. So you should work that out on average. So, and then work out what your win-loss ratio is, work out the numbers, and work out what you need to do to at least break even or consistently go forward. Anyway, I hope that's been helpful to you.